Have you ever noticed that the biggest financial disasters rarely begin where everyone is looking? In 2008, most people believed the biggest banks were too strong to fail. The housing market seemed unstoppable. Wall Street looked confident, and financial experts kept reassuring investors that everything was under control. Then, almost overnight, the illusion disappeared. Trillions of dollars were wiped out. Millions of people lost their jobs, families lost their homes, and one of the worst financial crises in modern history changed the global economy forever. Today, almost 20 years later, many investors believe the financial system is much safer than it was back then. Banks hold more capital, regulators have introduced stricter rules, and stress tests have become routine. On the surface, everything appears more secure. But what if the next crisis isn't hiding inside the banking system at all? What if it's growing quietly in a part of the financial world that most people have never even heard of? A market that has exploded in size over the past decade, operates largely outside traditional banking rules, and has quietly become one of the biggest sources of corporate funding in America. That market is called private credit, and according to a growing number of investors and economists, it could become the starting point of the next financial crisis. To understand why private credit has become such a concern, we first need to understand why it exists in the first place. After the 2008 financial crisis, regulators made it much harder for banks to take excessive risks. Banks were required to hold more capital, reduce risky lending, and follow stricter lending standards. These reforms made the banking system stronger, but they also created an unintended consequence. Many companies, especially medium-sized businesses, suddenly found it much harder to borrow money from traditional banks. That created a massive opportunity for investment firms, private equity companies, and specialized lenders to step in. Instead of banks making the loans, private investment funds began lending directly to businesses. This became known as private credit, and at first, it looked like a perfect solution. Companies received financing, investors earned attractive returns, and everyone seemed to benefit. For years, private credit remained a relatively small corner of the financial world. But then something remarkable happened. Interest rates stayed extremely low for more than a decade, making traditional investments like government bonds far less attractive. Pension funds, insurance companies, university endowments, and wealthy investors started searching for higher returns. Private credit funds promised exactly that. They offered yields significantly higher than public bonds, while marketing themselves as stable, professionally managed investments. Money poured into the industry at an astonishing pace. What was once a niche business gradually transformed into a market worth well over $1 trillion. Yet despite its enormous growth, most everyday investors still know almost nothing about it. At first glance, private credit doesn't sound dangerous. After all, lending money to businesses is a normal part of every economy. Companies borrow to expand, hire employees, buy equipment, and develop new products. The problem isn't lending itself. The problem begins when too much money starts chasing too few quality borrowers. As billions of dollars flowed into private credit funds, competition intensified. Lenders eager to deploy capital gradually became more willing to accept weaker protections, riskier borrowers, and more aggressive loan structures. Some companies that struggled to qualify for traditional bank loans suddenly found private lenders willing to finance them anyway. Investors kept earning attractive returns, so few people questioned whether the risks underneath the surface were quietly increasing. This is where history starts sounding strangely familiar. Before every major financial crisis, there is usually a period when easy money encourages excessive risk-taking. Investors become confident that losses will remain small because recent performance looks strong. Borrowers assume they will always be able to refinance their debts. Lenders believe defaults will remain low forever. Eventually, These assumptions become deeply embedded throughout the financial system. Then one unexpected event changes everything. It could be rising interest rates, slowing economic growth, declining corporate profits, or simply a sudden loss of confidence. Once borrowers begin missing payments, lenders quickly realize that the risks were much larger than they originally believed. Private credit carries another characteristic that deserves attention. Unlike publicly traded bonds, many private loans do not trade on open markets every day. That means determining their true value isn't always straightforward. During normal economic conditions, this doesn't appear to be a problem. Investors receive regular interest payments, and everything looks stable. But during periods of financial stress, uncertainty grows rapidly. If investors suddenly want to withdraw their money, selling these loans may become much more difficult because there may not be enough buyers. Liquidity, which simply means the ability to quickly convert investments into cash, can disappear much faster than people expect. History has repeatedly shown that markets often remain calm until liquidity suddenly vanishes. Another reason private credit deserves attention is the type of companies that often finances. Many borrowers are already carrying significant debt before they receive these loans. Some are backed by private equity firms that have financed acquisitions using large amounts of borrowed money. Others operate in industries facing slowing demand or rising costs. These companies often depend on steady economic growth to comfortably meet their debt obligations. If the economy weakens, even slightly, their financial position can deteriorate rapidly. Rising interest rates make refinancing more expensive. Slowing consumer spending reduces revenue, and shrinking profit margins leave businesses with less cash available to service their loans. Over the past few years, one major change has made this situation even more important. Central banks dramatically increased interest rates to fight inflation. While higher rates help reduce inflation, they also increase borrowing costs throughout the economy. Companies that became accustomed to extremely loans that once seemed manageable suddenly become far more expensive. Businesses that relied on continuously refinancing their debt may discover that new financing is no longer available under favorable terms. This is exactly the kind of environment where financial stress often begins to build quietly beneath the surface. One of the reasons private credit receives less public attention than the stock market is that it doesn't generate dramatic daily headlines. Stock prices move every second, attracting constant media coverage. Private loans, on the other hand, remain largely hidden from public view. Their values are updated less frequently. Many transactions occur privately, and information is often available only to institutional investors. This lack of visibility can create a false sense of stability. Just because a market appears calm doesn't necessarily mean risks aren't increasing behind the scenes. In fact, some of history's biggest financial problems developed quietly for years before finally becoming impossible to ignore. Some respected investors have warned that financial risks often migrate rather than disappear. When regulations make one area of the financial system safer, risk doesn't magically vanish. Instead, it often moves somewhere else where oversight may be lighter. That's one reason many analysts are paying closer attention to private credit today. They aren't predicting that every loan will fail or that every investment fund is in danger. Rather, they're asking an important question. Has so much money flowed into this rapidly growing market that investors have become overly optimistic about the risks they are taking? And if economic conditions continue to weaken, could this overlooked corner of finance become the place where the next wave of financial stress begins? Imagine a scenario where economic growth slows more than expected, consumer spending weakens, corporate profits begin to shrink, and businesses that were already carrying heavy debt suddenly face much higher borrowing costs. One missed payment doesn't create a financial crisis. But when thousands of companies experience the same pressure at the same time, lenders become more cautious. They tighten standards, approve fewer loans, and focus on protecting their own capital. Businesses that were depending on fresh financing suddenly discover that refinancing is no longer as easy as it was just a year earlier. That is how financial stress can spread not through a dramatic event overnight, but through a gradual tightening of credit across the economy. This matters because credit is like the bloodstream of the financial system. Companies use borrowed money to expand operations, build factories, invest in technology, and hire workers. When that flow slows down, business activity often slows with it. Projects get delayed, hiring freezes become more common, and management teams begin looking for ways to reduce expenses. For consumers, the effects may not be obvious at first, but over time they can appear in the form of fewer job opportunities, slower wage growth, and weaker economic confidence. One reason analysts continue watching private credit closely is its close connection to private equity. Many private equity firms acquire businesses using significant amounts of borrowed money. That strategy can work well when the economy growing and financing remains inexpensive, but when interest rates stay high for an extended period, those same debt payments become much more expensive. Companies that once generated comfortable cash flow may suddenly find themselves under pressure. Not every business will struggle, but the margin for error becomes much smaller. Another important factor is investor confidence. Financial markets often function smoothly because participants believe they will be able to access their money when they need it. If confidence weakens, investors may become more cautious, even if the underlying assets haven't changed overnight. History shows that markets can move from optimism to caution surprisingly quickly. That doesn't automatically lead to a crisis, but it can amplify existing weaknesses. This is why many experienced investors pay attention to trends that don't make daily headlines. They look beyond stock prices and ask bigger questions. Are companies becoming too dependent on borrowed money? Are lenders taking on more risk to earn higher returns? Are investors assuming that recent success will continue indefinitely? These questions don't predict a crash, but they help identify areas that deserve closer attention before problems become obvious. It's also important to keep the risks in perspective. The private credit market is not identical. 2008 financial crisis, regulations, bank balance sheets, and overall financial conditions are different today. Many private credit funds are managed by experienced professionals who carefully analyze borrowers and structure loans to reduce risk. That means any future problems, if they occur, may look very different from past crises. Financial history rarely repeats itself exactly, it often rhymes. Still, one lesson appears again and again. The greatest risks usually develop during periods of confidence rather than fear. When markets perform well for years, it's easy to believe that the system has become safer than it really is. Investors gradually accept more risk, and lenders compete more aggressively for business. Those decisions may seem reasonable individually, but together they can make the financial system more vulnerable if economic conditions change. For everyday investors, the biggest takeaway isn't to panic or assume a crisis is inevitable. Understanding where risks are building can help people make more thoughtful financial decisions. Markets go through cycles, and preparation is usually more valuable than prediction. Whether private credit becomes the source of the next major financial disruption is something nobody can know with certainty. The economy is influenced by countless factors, from inflation and interest rates to geopolitical events and technological change. But asking difficult questions before problems become obvious is exactly what thoughtful investors have always done. So perhaps the real story definitely caused the next financial crash. The real story is that a rapidly growing market with complex risks and limited public visibility. It requires curiosity, discipline, and a willingness to look beyond the obvious. If you found this analysis valuable, remember that the goal isn't to predict the future with certainty. It's to understand the forces shaping the financial system before they become front-page news. Stay informed, keep asking questions, and never stop learning, because in investing, the people who understand risk before everyone else are often the ones best prepared for whatever comes next.